Hi, welcome to Search for Yields, the weekly bond newsletter from INR Bonds. I am Arjun Patsati. And in this week's newsletter, I'm going to talk to you about why it's not over yet for interest rates and bond market. And this question has been asked to me by investors and financial advisors alike. Is that is there finally some stability coming up? And when will it take for the markets to actually retain its stability and stay stable for a while? And before I give you the answer, do not forget to register for our webinar on 27th of July, 4 p.m., where we will discuss what bonds to avoid in this particular market conditions. The registration link is given in the description below. And coming back to the newsletter, search for yields, and coming back to our main topic is is everything over for the bond market in terms of getting back its stability. Now let's see what are the risks that are still prevalent in the market, right, or prevailing in the market. Now, the first thing is that the global risk aversion on very high inflation. Now, inflation in the US is over 9%. In many parts of Eurozone, it's over 9%. Central bank rates are still way below, and they have a long way to go before they can before they can actually come to some semblance of a normalcy in where the interest rates should be. And it's going to take the full year, maybe the next year as well, in terms of where the rates should normalize. And having said that, the central banks, even if there is an economic downturn or markets are falling, equity markets are down, they will not be in a hurry to reduce rates because they've seen what the heavy liquidity they're given to the markets can do to inflation. And this inflation is now hurting the very same people they're actually trying to help by growth, promoting growth. And the consumers are facing a huge problems with the high inflation. And this is the first time uh, the developing world in 40 years plus has seen such high levels of inflation. So that's the risk of raising higher rates and then bringing down liquidity in the markets is going to be very high. And with all this, the China is still going through a very heavy lockdowns, and there's a huge amount of supply chain disruption, and all that is again hurting all the uh, uh, prices in the supply chain, and this is going to keep inflation much higher. So, with inflation risks, with economic risks, with capital outflows, and all that will is going to keep the markets on an edge. Okay. We have seen in India, we have seen a huge amount of money pull out by foreign portfolio investors or foreign institutional investors, very large from the equity part of it, and all that is showing in the rupee. The rupee is down to below rupees 80 to the dollar, and this is the lowest on record. And while INR bonds, we have always been saying that 80 is not far away. It did touch 80. Now the question is, what is the next level? Is it 85? Hopefully, it's not 85, but then it can be ruled out. And given that inflation is so high in India itself, the wholesale price inflation is at 15 plus percent, while the retail inflation is at 7%. Now, why is there so much of difference? Because the fact that when cost of materials is going up, many producers and manufacturers may not have the uh, ability to pass it on fully to the consumers. So they'll have to do it in bits and spurts. So that will keep rising. The prices will keep rising at the consumer level. The second is the government itself. Now they have cut fuel prices. There will be a lot of clamor to cut other prices as well. And all that will go back in the form of subsidies. And when it goes back in the form of subsidies, then the government budget deficit swells up. And when the budget deficit swells up, then what happens is that the government comes to the market to borrow more. And this year in 2020 to 23, there is a record borrowing by the government, both the central government and the state governments. And when they actually have to, given that inflation is so high, the government cannot raise taxes as well, because inflation is also a huge tax on the consumers. And then further to that, if the government imposes higher tax, then the consumers are going to suffer very badly. And this is definitely not a political. Uh, it's not politically correct for the government to do that. And also, it's not. The consumers can only be taxed so much. Inflation is definitely taking a beating. Now, so clearly, with all this, what's going to happen is that there is absolutely nothing visible going forward that interest rates are going to stabilize with high inflation, global rupee at record lows, and rupee at record lows also increases import prices of goods and services. And with domestic government borrowing, very high government borrowing, all that will keep the cheque yields up and will take it up further, right? And once they and the, so the- unless there is stability on the macro front in terms of inflation and interest rates at high enough levels so that it can actually help bring down inflation. Interest rates only alone is not going to bring down inflation. A lot of other factors have to work, and so hence interest rates are going to get hit. And when interest rates are rising, then other parts of the lending economy also has a a problem, because when interest rates are high and there is inflation, the demand for goods and services go down. So investment demand, many corporates that have borrowed for investments may not see their capacities getting filled up. And when they do not see that, there is then they would have a downturn. And when there is downturn, the amount of debt in their books will look much higher. And with equity markets also down, they cannot raise capital to bring to bring stability to the balance sheets. And in the lending space as well, a lot of consumer companies, consumer loans, which have been unsecured loans to SMEs and MSMEs and others, can also see a tough time, because many of the borrowers could have been doing well in a very strong economy, but with inflation and the interest rate risk very high, then there could be more defaults. And when there's more defaults at the consumer level or the retail or the small borrower level, then all the lenders could also see a huge amount of stress on their loans. So hence, it's not a good time to actually say that things have stabilized. So it's going to take a while. Investors and financial advisors will have to calibrate their investments accordingly, uh, in the view with a view that interest rates are going to take a long while to stabilize, or the bond markets are going to take a long while to stabilize. Hence, that should be the strategy. And we will explain this all in our webinar on the 27th of July. Before I sign off, do not forget to download our app, QuickInvest by INR Bonds, which is gives you the curated list of bonds with our own proprietary risk score model that takes into account all the risk factors that I mentioned. And this is helping both investors and financial advisors select the best bonds for their investments.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.